I wanted to bring you something today that I think is super valuable. Basically, it says it right here in the title. We must know where we are before we can go forward, right? So being able to stop, take a measure, take a knee, and let's look at our situation right now and kind of understand the forces that kind of caused us to be in this situation, okay? And the best way to do that, I think, is with charts, all right? There's so much data out there right now that, you don't need to overdo it. It's kind of like cilantro, right? You don't need a lot of it to kind of create the effect, all right? So in my opinion, this is really all the data that you need. All right. If anybody wants sources, just go to MWMfund.com and click on the sources tab, and I can get you all of these charts. Okay, let's move forward. Now, I want to start off by saying this. The goal of this presentation, right? Understanding the present conditions we're in and what basically caused them, right? So now I want to jump right into the charts. Okay, so what we're going to be looking at here is inventories of homes, how fast they've sold, how many pending homes there are out there currently, and you're going to see some really strange anomalies here. Now, can you spot the oddball in this first one, right? Look at this guy. He's like lost his way. He got separated from the pack. So this is a trend line, right? 17, 18, 19 that you're looking at, inventories of home available. Now, it's not lockstep, but it does run along a certain type of trend line. Look at 2020. Wow. I mean, that is a super low amount of inventory, right? Now, here's the share of pending home sales off market within 2 weeks or less, meaning that I listed a home and in 2 weeks it's sold. I mean, look at the trend line, pretty, consistent. Look at who is the oddball here. That is crazy. That is really, really good, in my opinion, if you're looking to sell a home, right? It's obviously everybody's saying it's a great time to sell a home. It's also a great time to invest in real estate and mortgage notes and stuff because of what you're seeing here. Things move fast. The velocity is fast. Liquidity is quicker, and all that. So, and then you're looking at this seasonally adjusted single family homes available. I just want to point out, look at how low that is. And then you kind of look at this. This is kind of the bread and butter where we live in, right? And I've always been saying, why don't we just use more of our existing supply of single family homes to help with this affordable housing, crisis that we're in, instead of just always relying on new homes, right? We're just such a throwaway society, and I really believe that that's going to start to change. Well, it has to change because it just can't maintain the way that it's going now. So you can kind of see this line. Look, these are existing family homes. I mean, look at how much it's gone down. So do you think that it's like all of these homes just are bought up and non-existent? No. What, in my opinion, what I've seen over the last 8-9 years of being in the mortgage note industry and 20 in the real estate industry is that these homes right here are in debt purgatory. Simply what I mean is this. A bank or a big institution or big hedge fund might have a bunch of these lower value homes that are only worth $100,000, right? They don't want to deal with it if it goes non-performing. It costs too much money, too many resources. So what they do is they trade those off. Now, if nobody buys those, they continue to be traded off. So debt purgatory is this. There's so many affordable houses sitting out there, right, that are on the balance sheets and portfolios of these bigger institutions that they just continue to trade off, and they're not being released to the general public. The reason why I know this is we get so much inventory coming across our desk every day that if it wasn't for us buying it and reaching out to that borrower, right, and then getting that home back from that borrower, if that's what the borrower chooses, then nobody's going to really do it. So what we do, okay, we don't need to wait for 1,500 days for a foreclosure to go through so one home can get released to the general market. That 1,500 days, too, by the way, is a realistic number of how long things are taking in certain areas of our country to go through the foreclosure process. That basically means this affordable home right here is going to take 1,500 days before it's available to a new family. That is crazy. We can come in before that, right, and buy that. Right? Before it even goes to a sheriff's sale, we buy it before that even happens. We don't have to wait, clog the court systems, have the government, local government spending all this money on extra resources for the court systems. We can actually buy them quicker. We can get those back property taxes paid back faster. And you know what? I don't even think I need to kind of go on anymore about that. And I promise I won't go down on a rabbit hole anymore following up on these next charts. But this is really kind of what I wanted to, let people know. MWMfund is really going to be able to help our current situation now and for future years to come with our strategy. So let's move on. Okay, huge spike in sales, guys. I mean, would you think anything different? I don't think so, right? I mean, look, cheap money, low inventory, it's going to create a feeding frenzy, right? Look at this move. It's an extreme move. This is a median line right here, right? This trend line. And for since 10, it's been kind of consistent, right? Up and down, up and down. But look at this. What happened here? I mean, that is crazy. That's like a zero G, I call it a zero G plane flight plan that's going, you know, those planes that actually, you know, create zero G by going down and then extremely up. Now, I ask you in the audience, what could have caused this spike, do you think? What do you think? Let's move on. Now, most things are trending upwards, right? Now, there are a few things that are trending downwards, but that's also a good thing, and I'm going to show you here in a minute, okay? So here's trending upward. Let's go to some charts, right? I want to show you some different charts and then explain a little bit about what these actually are and how you measure them. And I'm going to really make it simple for everybody kind of, you know, to understand. You can kind of see this is housing starts. We obviously know that things are trending upwards on that, you know, and the same thing. It's a huge spike that you can kind of see. But this one right here, the Fannie Mae Home Price Sentiment Purchase Sentiment Index. Why I like this is because it's polling the real people out there and asking them some questions. And they're asking these questions like, you know, do you think it's a good time to buy a house now, somewhat of a good time, or not at all, right? Those types are the types of questions that they're asking. And if you want the full amount of questions they're asking, like I said, reach back out, go to MWMfund.com, request that, and I can get that for you. But so here's how you read this Fannie Mae Home Purchase Price Sentiment Index. It's hard to say. HPSI, I think I'm going to start saying right now, right? Okay, so low is not confident about the current market, right? The current housing market. High is confident. So you can kind of see it's been trending upwards, right? What happened? Obviously, we know what happened, and then now it's starting to tick upwards again, which is a good thing. You can kind of see a little bit bobble there, but we've, you know, in my opinion, it's going to continue to trend upwards as money continuously stays as cheap as it is and interest rates stay low. So, you know, you can kind of see, and I'm going to read a little something about how they actually measure this, okay? It's a national housing survey, and it's a monthly national housing survey. And what they do is it's a telephone survey. It polls over 1,000 consumers a month about owning and renting a home and asking those types of questions, you know, about the economy, household finances, overall consumer confidence. And it asks, you know, 100 different questions, and then 6 of those are distilled into coming up with this price. I don't want to really get into, because I don't know how they actually measure all that with all the different questions and the numbers. But, you know, in general, I want to ask you guys, do you think that this is a very good time to buy a house? Somewhat good time, somewhat bad time, or very bad time to buy a house, right? So those are the types of questions that they're asking you. You can kind of think, looking at what you're seeing here, do you think it's a good time to buy, or do you think it's a good time to sell? And then, you know, you can kind of go from there. But it's a very interesting thing to be able to provide signals for the future of housing. So I always look up this HPSI and kind of see what people out there are kind of looking at, and are they confident, right? This is a really good chart to always look at, and an index to always look at as well. Let's move on. Now, I said this is what you call accommodative monetary policy for sure. So what's accommodative monetary policy? That's the current situation we're in, right? Accommodative monetary policy. It basically means, you know, when central banks, Fed, right, expand the money supply to boost the economy, right? So you hear about this printing money, and so really who's printing it is the U.S. Treasury, but the Fed, the central banks actually push that button and say go, right? Now, monetary policies that are considered accommodative include lowering the federal funds rate, obviously lowering rates to borrow, which will increase spending. If money's less expensive to borrow, it encourages more spending, right? Now, one of the really interesting charts that I wanted to bring to here, and it's really an interesting one that hasn't been around. You know, it wasn't like this for a long time. If you look at right here, you're looking at primary and secondary mortgage rates. Look at how low this is going. I mean, it's insane how low everything is going. So what does this do? Cheap money, lots of inventory. What's going to happen, right? So look at the interest rates too. This is the borrower note rate, extremely low. Now this Exhibit 51 is one that I really always kind of look at. And most people that invest in mortgage notes or mortgages or what have you, real estate, kind of want to know, as this is an exit strategy, right? It's a refinance. You can only refinance if you're in the money. So it's at almost an all-time high. 80% of outstanding 30-year conventional mortgage have at least 50 basis points incentive to refinance. Basically, they're in the money. So a lot of these people can refinance and get out, which will kind of differentiate what's happened back in the last crisis. Now, MBS, mortgage-backed securities. Who lived through 2006, 7, and 8, right? Mortgage-backed securities. They were considered the hot garbage back then, right? Nobody wanted those things after that, after the last the collapse, right? But I'm going to show you something really interesting here, right? Here we go. Exhibit 55. Where is Waldo? I say, where's Waldo? You think something happened right here? Look at the amount of purchase volume that the Fed, right, has been spending in buying up mortgage-backed securities. Basically, I'm going to originate a bunch of mortgages, and then I'm going to be able to sell them to the Fed because they say, we're going to buy those 100%. You generate them, we'll buy them, and then we'll securitize them, okay? And then they put them out there for sale for investors to buy. Now, look at Exhibit 53, right? This was 09. This is how much the Fed was holding of agency mortgage-backed securities. Look where we are at right now. $2 trillion of mortgage-backed securities, guys. Do you think they're buying a lot of stuff? Absolutely. Now, what happens when they stop buying? That's the question, right? That's the question. That's the million-dollar question. So what I always say is, follow the cashola. The Fed, if you can believe this, and this is not a typo, it's $23.4 billion a day they're spending to help buttress our economy and spend and keep our economy going. I'm not saying it's bad or good. I'm just giving you the facts of what's actually going. And how do I know these are the facts? Because like I tell everybody whenever I do these videos, I say go right to the source. You can go right to the Federal Reserve, right, .gov, go right there and find out exactly what they're spending on. You can kind of see what they're buying, where the money is moving. All right. GDP, you always have to kind of gross domestic product. You got to always look at that, Is it good? Is it bad? It just basically measures the amount of stuff that we're producing as a country, right? Kind of gives us a good idea of what's happening. Now, look at this. Here you go. Central banks. These are all the central banks, the G10, right? So this is the trend line for them. So every country, here's us right here, you can kind of see spiked up, obviously right then and there. In spending, this is in balance sheet size. This is meaning that they're buying stuff, public equities, right? Not directly, but in ETFs or buying up mortgage. They're buying everything. You put it up for sale, the Fed will buy it. Right. So remember, a lot of these central banks are buying up, indirect public equities. So they're the biggest buyer. What happens when this goes away? Now, that's what I look at, right? What happens that when the Fed takes all this away, what happens to the stock market when they're one of the biggest buyers out there of stuff, right? And this is what we kind of look at as investors, investment managers, and try to bet on what's going to happen. Right? When do they take away this? When do they take the gas pedal off that monetary policy and just continuously print more money and more money? I don't know. Whatever needs to be done is the glaring indicator here, right? I'm going to show you something. Stabilized financial markets and brought the most accommodative financial conditions on records. Remember, we were kind of talking about accommodative monetary policy, right? Accommodative policy. That means we're going to accommodate you to the best of our ability. all right, to continuously keep the money flowing, continue our economy going on. And you can kind of see, look at the world and the US, right? We really kind of run lockstep with everybody else. So it's like, you know, when people say, who cares what's going on over there? I only invest here. Well, that's not how it works anymore. The world's flat. No matter how many people say, look, the world is flat. And I don't mean the flat earth people. I'm saying the world is flat, that everybody is kind of in the same ecosystem, right? And we're all kind of following along the same trends, right? Everybody is kind of moving in lockstep. It's not just the US and then the rest of them, right? So here's a result, right, from easy money and an inventory of property deficit, right? Here's a simple graph that'll show you the results from that. Here you go. Housing price appreciation has accelerated to double-digit pace in recent months. Once again, off the charts. Look at this. I mean, that is insane. We haven't seen that for a long. So, no homes, lots of cash to buy homes, creating a classic supply-demand issue, right? And I think this will kind of, you know, stabilize over time, obviously, but it's only a bet or a hunch, and there's maybe a micro bubble that will be established there, but nothing, I don't think, that will really hurt the real estate market overall that bad. So, I mean, we got to touch, you know, if you're talking about the economy, you have to also look at the stock market, right? Because as an investor, a lot of investors I talk to are diversified. They have the stocks, they have the real estate, they have mortgage notes, they have alternative investments, they have online investments, they have different stuff, right? But you always got to kind of see where the stock market guys and what they're doing, because it really does influence a lot of what we're actually doing, okay? So what I want to do now is I want to kind of go to this indicator right here. You can kind of see that on chart 7, right? The largest 2-week inflow to global stocks ever just occurred, right? Look at this. Look at the amount of people flowing into global equities. Now, here's the percent of respondents who believe the next 10% move in stocks will be up. This is extreme. This is why everybody right now is calling. Is there going to be a bubble happening? Very smart individuals are saying you can't sustain this in the market. It's going crazy overvalued. It's insane. Here's the sentiment indicator as well, okay? Now, you look at it as from one polar opposite to the end, all right? Look, this right here, and all of this is really, really fueled, okay, from, I don't know if you know, Robinhood traders are calling. Robinhood is an online investment portal where you can buy and sell stocks for free and basically day trade, right? So a lot of the influx of the 12 million new plus Robinhood users, that means 12 million new stock traders out there came from sports gambling. Really, a lot of sports gamblers out there that handicap you know, gambling and in sporting events, which is a gigantic business, didn't have anything to do when COVID hit. So they kind of moved their ability to be able to make moves and gamble into the stock market. And Robinhood was just there waiting for them to do it. So it's very interesting to kind of, you have to look at the social systemic effects that occur that are not always in the spotlight, right? And like that gambler thing, right? So a lot more gamblers right now, if you know them, are looking at different types of investments until that sports gambling continues to pick up again, right? One last thing I wanted to bring you is this chart right here. So call option, you're betting that it's going to go up. Your put option, you're betting basically that it's going to go down, right? So when you start to see a super low, you know, ratio here, right? If the put-call ratio is above 1, okay, typically this indicator it's used to gauge market sentiment, right? If it's above 1, you know, people are really, really confident that the market is not going to go not going to go up anymore, right? It's going to start to go down. Now, if it's lower, that basically means that there are so many people right now so confident in the market because of this 20-day moving average you see here against this S&P that was laid over on this chart, that it's so low, I don't even know where it can go, right? I mean, it's crazy. It's overheated to me, right? So for those of you out there, I'm not saying the stock market's bad. What I'm saying is you got to kind of understand where you're at before you go where you're going, right? And, the nice thing is you're able to look at these charts, you're able to kind of get a better picture of what's going on here. And so when you are kind of looking at an investment like MWMfund, or you're looking at diversifying into another online investment, you kind of want to know where you're at, what those investment managers are actually looking at, and what they're doing. Are they thinking? A lot of this is to show you guys out there that yes, I am thinking when I am managing stuff, and I have a plan, right, to continue to move the fund forward. Granted, because of what you've seen here, it's a little bit different than what we originally wanted to do, but it needs to be done in order to survive. Okay, so I wanted to bring that all to you. It was a little bit long, but I hope you enjoyed it. Once again, I'm TJ Osterman with MWMfund. I'm the CEO and asset manager here at MWMfund. And if anybody has any questions, go to MWMfund.com. You can always schedule a call with me to talk really quickly. We have a lot of newsletters going out, really good educational content. So please share it if you see something on LinkedIn. Share it on Facebook if you do see a post from us and you like us. And I wanted to thank all of you investors out there that have already kind of the early adopters of MWMfund and the brand we're trying to build here. Thank you so much. Without you, we wouldn't be at where we're at now. Okay, so I wanted to say God bless. Let's continue to move forward and work together. And I believe that 2021 is going to be our best year ever out there if you're in the real estate market or mortgage notes market. So make it a great day.